Okay, so now let's work on learning objective number 2. I'm going to explain to you how to account for the reacquisition of shares reacquisition. So the question is, why company will reacquire their shares, right? So they issue the shares to the market in exchange for cash from the investor. They are using their cash, the capital, for their operation, right? But sometimes the company will go to the market to buy the shares back. Okay, so they pay the seller on the market in exchange of shares. So they want to buy back the shares, right? So why they are doing this, right? So one thing is, let's say on the stock market, the share trading is not that active, right? So then the company will be like, okay, so nobody is buying the shares. Guess what? I have to buy, right? I have to make sure that the trading is ongoing, right? So there is an active pricing mechanism there. So if nobody else is buying, maybe I have to buy, right? I need to buy to increase the share price. So when you buy the shares, okay, there are less shares on the market, right? There are less shares in the market. So therefore, okay, the earnings per share is increased because earnings per share is calculated using earnings divided by the number of shares outstanding in the market. So the numerator is reduced because of the reacquisition. So the earnings per share will increase. Sometimes it could happen that another party is trying to take over the company, right? So how can you become the boss of the company, right? So if I have lots of money, I can be the new boss, maybe a new major shareholder of Microsoft. So it's pretty. If I have enough money, what I'm going to do is I'm going to keep buying from the market, right? Until I have more than 50% of the share, the share capital. Guess what? I will be the major shareholder, right? So basically, there is a possibility that you may have hostile shareholders trying to buy your whole company. They do that by keep buying the shares so that they are going to be a major shareholder. And guess what? They're going to have a seat in the board of director. They are going to have influence on the company, right? So if, let's say, my company knows that there is a very hostile investor, he's going to keep buying my shares. So how can I make sure that their plan won't be successful? Guess what? I'm buying too, right? If you keep buying, I'm keep buying, right? If I'm piling stocks to increase my shareholder, right, percentage of shareholder. So eventually, right, you are comparing who has more, right? So if they're buying, I better buying, right? So that's the case. Sometimes they may need the shares for compensation to the CEO, right? Let's say the CEO not only receive a salary, but also receive stock dividends. But the company, instead of issuing new stocks, they can just buy the stocks from the market and then give it to the CEO, right? In a lot of cases, these shares, after their reacquisition, they will be retired and canceled, okay? Instead of to use them again. In most of jurisdictions, they are going to retire it and cancel it. Does this make sense? Does anyone have any question?
I didn't understand the buyout hostile shareholders.
Oh, the hostile shareholders?
Yeah.
Okay. So let me use a very simple example, okay? So let's say in the market, there are there are only 100 shares outstanding, okay? And right now, you are the major shareholders. You have let's say 40. You have 40 shares, okay? Anna has 30 shares, and me has 30 shares. Okay, so add them up. You have 40 plus 30 from Anna plus me 30. So that's 100 shares, right? That's all the shares in the market, right? Okay. Who is the major shareholder right now? Among three of us, who
Me.
is the major? You, right? Because you have more shares. So in fact, the percentage of your ownership is 40%. And percentage of ownership for Anna is 30%. For me is also 30%, right? So 40%, 30%, 30%, and you are the major shareholder. You have more ownership than all of the single shareholders, right? Okay. So now guess what? I don't like the policies you are dealing with, right? I want to have a say, right? So guess what? I'm going to keep buying from Anna. Okay. So I would try to buy from Anna. Let's say I will buy 30 from Anna, right? Think about it. So Anna has 30, right?
Yeah.
And if I'm able to buy all the shares from Anna, so my new number of shares will be 60, right? So in that case, Anna will be no longer the shareholder. I have 60, you have 40. So who is the boss now?
You.
I'm the boss, right? So then I would have more say, right? I want to change the corporation. I want to do things different from what you have done before. You know, those type of things, right? Yeah,
Okay.
but then the moment you realize that, right, I am buying, right? I am buying, then you will start buying from Anna as well, right?
Okay.
Yeah. So um so so I could have a different company, right? So I could have a different company. So maybe I just want to, you know, let's say in the beginning I'm not even a shareholder, right? You have it's three of the other person. Let's say I'm not your part of group, right? So another man have 30, right? I'm not a shareholder at all, right? So and then I start buying from you, right? And then you guys will have to buy from the market so that my ownership will not be significant enough that I become a major shareholder. I'm gonna have influence. Does that make sense?
Okay. Yes.
Anna, are you okay with this?
Yes.
Okay. Um, so how can we record the transaction? Okay, how can we record a transaction? So when you reacquire these shares, okay, your share capital balance will decrease. Okay, the share capital balance will decrease, and your cash is going to be used because you use cash to buy from the market. So any difference between the cost of the share, that the cost of share is what you paid for, the company paid for, right? Versus the amount you paid, which is the price at the reacquisition. There may be a difference, right? Your cost when you purchase the shares, the average cost, may not be the same as the price you are paying to acquire them back, reacquire them back, right? So if there's a difference, that difference will be recorded. And we're going to talk about how to record that difference. If you are requiring it back at a lower price, is that a good thing or bad thing? So, so you issue the shares at an average cost. If you are able to buy the shares back at a cheaper price, is that a good thing or bad thing for the company?
A good thing.
Mm-hmm. A good thing. So then your equity will increase, and that difference will go to equity account called contributed surplus. Contributed surplus. Okay, so in this example, so what happened is the cost. Let me think about, yeah, the average cost. The average cost is $2. Okay, so that's when the shares were issued, right? So you think about when you are issuing shares, you get money from the investor. On average, investor pay you $2 per share. Okay. Now you want to acquire the shares back. And the good thing is now you can get it back. The price is $1.50. Right? Is this good thing or bad thing for the company?
A good thing because
good
you're
thing.
getting the same but cheaper price.
Yeah, very good. So now you require the share, you retire them, so your share capital will decrease, right? So to decrease your share capital, okay, by 5,000, you retire the 5,000 shares, and on average, each one is $2. So the cost of the common shares you retired is 10,000. Okay, the investors originally pay you $10,000 for you to issue 5,000 shares, right? But now how much you pay to get them back, right? You pay $1.50 times 5,000. So you actually only paid $7,500, right? The cash to get them back. So it's a good thing, right? And there's additional, the additional goes to contributed surplus, okay, 2,500. So that's your equity. You have more equity, which is a good thing, right? So does this make sense?
I have one question. So the account contributed surplus is a liability?
It's an equity account.
Oh, okay.
So if it's a liability, you should be sad, right? If an event increase your liability, you should not be happy at all, right?
Yeah. Okay.
Yeah, but
And
this
it has,
account is an equity account. It's your money, right? So if this account is increased, that's a good thing. That's a good news, right?
yeah, okay.
Anna, does this make sense?
Yes.
Okay, so now you can see. Basically, you buy back the shares at a lower price than the average cost, right? Than the average cost when you issue the shares. But it can work the other way, right? The other way would be, what if that the average price is $2, the same, right? But the price when I acquired it, the price is $2.75. So I have to pay a higher price to buy back my shares, right? I pay $2.75, but when I issue the share, I only get $2, right, per share. But now, right, when I buy the back, I had to pay higher price, 2.75. So again, your common shares decrease, right? You acquire these common shares from the market. So that's 20,000, and you pay more cash, right? This time you paid 27 $1,500 cash. Okay, so you paid more cash. So that's a very bad thing, right? That's not happy news, right? So if it's not happy news, what is going to happen? Your equity will decrease, okay? Your equity will decrease. So how the equity is going to decrease, okay? So your contributed surplus, there are $2,500, remember from last slide, right? This account contributed surplus has $2,500. So whatever that bad news will first be balanced by the previous good news, okay? So first, that bad news will be will hit that contributed surplus account, okay? And the maximum is the balance, 2,500. But then you realize, right? So my debit is 20,000 plus 2,500. So I have a total debit of 22,500, right? So there is still a 5,000 debit. And we know this is the bad news, right? So then your return earnings decreased 5,000, right? Right. So your return earnings decrease, your contributed surplus decrease. Both are bad news. So in this case, together they can make up that $7,500 bad news, right? So does this make sense?
Yeah.
Anna, does this make sense?
Yeah, all good.
Okay. So the question is, what if there is no balance exist in contributed surplus? For example, you never really have any good news before. So your contributed surplus balance is 0, right? So then what happened is, so the cost is 4,000. You paid 4,500 to buy them back. So the $5,000 bad news cannot go through the contributed account because that account has no balance, right? So it has to go from return earning. So you have to think about if there's bad news. First, you want to check, is there a credit balance on the contributed surplus? If yes, so this account will first absorb some of the bad news, if not all, right? If that account cannot absorb all the bad news, the next account to go is the return earning, okay? But if there's no balance on the contributed surplus, then you cannot use it to absorb any balance bad news. So you have to use only return earnings. Does that make sense?
Yes.
Yeah.
Mm-hmm. You can almost think about a contributed surplus as a saving plan, okay? So you have a contributed surplus, like a saving pool here, okay? So in the good years, right, you have actual, right? You are saying, oh, guess what? Today I buy back some shares. I have some good news, $1,000 here. So that's good because that means on that acquisition, you are making this much money, right? So that's a good news. So you cannot put this good news here. And the next time, guess what? You have a bad news, right? You acquire the share back at a much higher price than the cost. And this time, the bad news is $2,000, right? So to deal with this, you always first, before you go to return earning, right? Before you reduce your return earning, you always go to check this contributed surplus. If there is a balance, then you know, keep that, use that balance first, right? So then you debit contributed surplus for 1,000, okay? And now this pool is become zero balance, right? And then you go, this is the first step. And then the second step, you go to return earnings, debit, return earning for another 1,000. Okay? So there's the order. When you are trying to absorb that bad news. Okay? Does that make sense?
Yeah,
Yeah.
Professor.
Okay, good. Okay, so that is my learning objective 2.